Hello and welcome to the Cedar River Capital second quarter market Touchstones slideshow. Today is June 15th, 2022, and we'll be discussing the main factors driving the stock market at present. My name is Paul Latta, and I'll be doing the narration today, but my business partner Baj Kochar and I are both available for questions and discussion. Our contact information is available on our website at cedarrivercapital.com. We'll begin today with a discussion about the recent market action, including a look at what's driving the markets today. We'll then touch on the top 5 points of discussion amongst investors today, and then we'll conclude with some historical context, mainly related to prior bear markets. This is a chart of the S&P 500 over the last 5 years. Good news is that the S&P is up a little over 70% in the prior 5 years. The bad news is that 2022, our current year, has been a very challenging year, down a little bit over 20% year to date, and officially in a bear market. Headwinds have been stronger than tailwinds in 2022 so far, and we'll talk about that on the next slide. On the right-hand side of the slide, we can see the top headwind being the Federal Reserve, which is aggressively raising rates to fight off rapidly rising inflation, likely a stagflation scenario. Headline Consumer Price Index inflation is at over 8% right now, about a 40-year high. So the Fed has raised interest rates at the fastest clip in over 25 years, in fact, up a full 75 basis points just this week. The Russian invasion of Ukraine is aggravating inflationary pressures, especially related to energy and food costs. And the rapid rise in rates is rippling through, especially to the rate-sensitive parts of the economy, a hard hit to those items that are frequently financed, like new homes, home remodeling, automobiles, boats, and more. And the higher rates are weighing heavily on consumer sentiment indices, which are in rapid decline and now at multi-year lows. Of course, it's important not to lose sight of the tailwinds, which are on the left-hand side of the slide. The top of the list there is clearly improving prospects for COVID recovery worldwide. Most countries of size are experiencing a tangible return to normal. Good news especially for the hard-hit travel and entertainment sectors. China seems to be the last country of size emerging from the shadow of COVID. Valuations have also improved, of course, mainly on the market pullback, but they are nearing multi-year lows. Lastly, bonds generally remain unappealing, with more Fed rate increases likely, though it's fair to say that bonds are less unattractive compared to with our slideshow a year ago. Enemy number one for investors these days is inflation. This begs the question, what goods and services are seeing the highest inflationary price increases? In short, the big problem is energy costs. Most of us have noticed the exorbitant price of gasoline at the pump these days, but the high energy cost extends to essentially all hydrocarbons like jet fuel, heating oil, natural gas, coal, kerosene, butane, propane, and others, whether crude or refined. Food costs are also challenging, though less so here at the finished consumer end of the value chain compared to the raw materials like wheat and soybean, where prices have escalated quite dramatically. Food and energy prices are important to watch, though prices are well known to be volatile, which is why the Bureau of Labor Statistics commonly excludes food and energy from their core measure of inflation indexes. That said, while high food and energy prices do not always translate into higher inflation, when we do have high inflation, food and energy are always problematic and at the root of inflationary surges. This is the sector performance of the S&P 500 year to date. Perhaps after the previous slide about energy inflation, it's no surprise that energy is the best performing sector year to date, and indeed the only sector in the green so far this year. I might mention that the S&P energy sector is fairly small as a part of the overall S&P. It's only 4% of the S&P, so a strong energy sector is not enough to lift the overall S&P. It's just too small. One might also expect the material sector to be doing a little bit better given the lift in food prices like wheat and soybean, especially at the raw material end. Alas, though, the materials sector includes both the food-related defensive names as well as the highly economically sensitive base metals like copper and steel, which are not having such a great experience. So the sector performance overall doesn't really mean much when the constituents are so bifurcated. Consumer and technology sectors remain in the basement. This does seem to be a repeat of the 1970s when energy and food roared, but consumer technology struggled. However, one key distinction is that in the 1970s, it kicked off with the collapse of the gold standard, which crushed the US dollar, the main cause of inflation in the early 70s. This time, the US dollar is incredibly strong. We'll chat about that later in the slideshow. This slide shows the market performance by style factor year to date. In the far right-hand column, you can see the performance in the first quarter as well as the second quarter to date through the middle of June. The style ranking mainly reflects a ranking by defensiveness. Income, value, low volatility are the top three, are inherently more defensive than growth, high beta, and story stocks at the bottom three. There are a few other factors at play, of course. Income stocks are defensive, but usually do not hold up so well amid rate increases since higher rates create more competition for other income vehicles. However, income stocks include three main subsectors: utilities, pipelines, and REITs. All three of these subsectors are being propped up by sector-specific factors. The pipelines are being propped up by inclusion into the energy ETFs, even though there is really no commodity price exposure. The REITs are being propped up since it is the only income vehicle that is inflation protected, since landlords can raise rents. And utilities are being propped up by essentially lower comparative yields versus history, reducing rate sensitivity. Growth stocks are under pressure, partly due to sector rotation away from the big five mega cap tech stocks, especially as investors rotate away from work from home stocks. But additionally, those names with advertising exposure are seeing additional pressure from the new privacy rules, as well as reduced advertising effectiveness amid economic slowdown. One of the backhanded upsides of a bear market is the virtual elimination of that valuation risk that is so pervasively discussed during a bull market. The market pullback has indeed improved valuations. The chart here shows the S&P 500 in blue and the forward PE ratio of the S&P 500 in purple, going back to the year 2015. The market multiple has dropped from just over 23 times in 2020 to the present level of about 15.7 times. That is now encroaching on a 10-year low of just under 14 times during the depths of the COVID quarantines in 2020. In previous slideshows, we compared the earnings yield of the S&P 500 to the yield on the 10-year Treasury, revealing a widening spread over recent decades and suggesting that stocks are undervalued relative to bonds. With the recent rate increases at the same time as the pullback in the stock market, the spread basically remains unchanged. Stocks are still more attractive than bonds. Earnings forecasters may cast doubt on the present market multiple since higher rates put earnings projections in doubt. Fair criticism. Still, if one uses a longer-term measure of stable earnings, like that of the cyclically adjusted PE ratio or the CAPE ratio, one will arrive at a similar conclusion that stocks are simply more compelling today from a valuation perspective, with a CAPE of about 29 versus a 5-year range of 24 to 40. We'd now like to move on to Chapter 2 of our slideshow, which is our top 5 list of the most discussed debates on Wall Street. Our top 5 list of the most pressing debates on Wall Street includes, at number 5, is the market pullback really that different this time, or is it just the same as the last pullback? Number 4, what rate hike cycle is most comparable to the one that we're in today? Number 3, can that $15 trillion stake in pro-environmental ESG investing actually do well amid an oil rally? Number 2, are consumers dividing into the haves and have-nots? And then number 1, is inflation now embedded into society at a level that can be regarded as persistent? We'll begin our top 5 list with the big question of the present recession threat amid higher interest rates, arguably the biggest threat weighing on markets today. But is it really different this time? Well, first of all, we'll take a look at the Bloomberg survey, and we can see that at present, there's about a 72% chance of a U.S. recession before the first quarter of 2024. That's up significantly from the last monthly survey in May, where it was at 45%. Of course, a year ago, it was less than 10%. This is actually corroborated with other surveys, the New York Fed survey, primary dealers, yield curve inversion, and whatnot. And also, it's not just the U.S. We have a similar survey results for Europe and Japan and other regions of the world. Is this recession threat different from any other recession threat? Well, every recession threat has both similarities and differences with prior recession threats. As we can see here, what's unique about this threat is the unprecedented pandemic followed by a war in the Ukraine, driving inflation to 40-year highs. For the first time in 40 years, the Fed has even suggested that a recession may actually be unavoidable. At the same time, though, we also know that supply chain bottlenecks are not permanent. Commodity supply will respond to higher prices with more supply. Higher rates will tamp down demand, and prior recessions have persistently been buying opportunities. So no, this is not the same as prior recessions, but no recession is a perfect repeat of prior history. There are similarities and differences. At number 4 on our top 5 list is examining prior rate hiking cycles in search of which cycle is most comparable to today. A bit of a spoiler alert here, but it's really the rate hiking cycle right around 1980 that's closest to what we have today, though as mentioned on the previous slide, there is no perfect repeat. Before looking into the prior cycles, it's worth just a brief textbook review of the 3 types of inflation. Inflation can either be demand pull inflation, cost push inflation, or built-in inflation. As shown on the table, demand pull is the most frequently discussed form of inflation, mainly since any sign of an overheating economy ripples through immediately to the bond market. Alas, though, despite intense focus, examples of actual demand pull inflation are rare indeed. Cost push inflation is not super common, more common than demand pull, especially in the US, but cost push inflation can be divided into two types, supply shocks and currency setbacks. We'll chat more about these on the next slide. And then lastly, built-in inflation is really derived from inflation expectations of society. Once built-in inflation expectations get embedded into popular culture, it becomes a cycle that is very difficult to break. Again, cost push inflation can be divided into two types, supply shocks and currency induced. Most supply shocks historically have been related to foreign oil and are usually geopolitically related, but they can also be act of God related, like weather disruptions and earthquakes. Currency setbacks, in contrast, are rare, especially in the US, happening only once in the last 100 years, 1973, a root cause behind the inflation in the 1970s. Currency setbacks are very common in a number of developing countries like Venezuela, Argentina, Turkey, all of whom wrestle with challenged currencies and therefore wrestling with cost push inflation. The main distinction between these two types of cost push inflation is that supply disruptions are usually self-correcting, along with prices too being self-correcting. However, a currency collapse does not uncollapse, so elevated prices just never seem to reverse. We're presently dealing with the cost push inflation here in the left-hand column, the supply disruption induced. With that background, let's take a look at some of the prior rate hiking cycles on the next slide. This is a summary of the last 10 rate hiking cycles over the last about 60 years. Note that 6 of the last 10 rate hike cycles were largely demand pull fears, and no actual inflation really ever manifested. However, 3 of the rate hiking cycles were cost push inflation, including the very rate cycle that we're presently involved with. Of course, the cost push inflation of the early 1970s was driven by the decline in the US dollar after the collapse of Bretton Woods and the gold standard. We clearly do not have that scenario today. The US dollar, in fact, is very, very strong at present, running about 20% over fair value based on purchasing power parity. This is a flight to safety play into the US dollar worldwide. This suggests that the late 1970s rate hiking cycle is probably the closest to what we're experiencing today. Indeed, both cycles experienced sizable geopolitical oil shocks, Iran Revolution in 1978, Russia-Ukraine invasion in 2022. And of course, by the late 1970s, the US dollar was not so weak anymore. However, there's also merit to revisiting the 1981 cycle, since this is the only cycle of pure built-in inflation, an outcome of seemingly persistent cost-push inflation throughout the 1970s. Fed Chairman Paul Volcker back then raised Fed funds to 1981 to an astronomical 20% in order to squelch inflationary expectations. Our present situation has two inflation catalysts, the Russia-Ukraine situation and the ongoing post-COVID supply chain disruptions. The combination increases the risk of cost-push inflation evolving into built-in inflation. Today's tough-talking Fed Chair Jay Powell is hinting at possible recession and is clearly worried about inflationary expectations getting embedded into societal thinking, not unlike 1980-81. Indeed, the last time inflation expectations became embedded, we had one of the Fed's only hard landings. This then is the message from the Fed. If we do not get our supply chain disruptions under control, Powell will create a recession like Volcker did in 1981 to reduce demand to match the constrained supply in a way where there is no inflation. With consumer sentiment softening in recent months, it appears society is already beginning to get this message. The COVID supply constraint story cannot exist amid recession fears, real or perceived. Moving on to number 3 on our top 5 list. Environmental, social, governance, ESG investors are seeing record outflows. Is it because people are dumping ESG to buy polluting oil and coal stocks, or is there a more subtle explanation? The chart here shows the sizable outflows in the month of May, over $2 billion. The bear market, of course, is partly responsible. That said, the last bear market in 2020 saw basically no outflows. What's different? Is it that oil roared and ESG investors were worried about getting left behind? Again, not really a full explanation. ESG does not automatically put scarlet letters on all oil companies. There is a more subtle explanation. ESG investing is not as easy as it sounds. Now, to begin with, ESG investing is actually quite huge at over $17 trillion as of the end of last year. Roughly a third of all US investable assets are ESG. But there's no rating standards at a regulatory level, which is a problem. Lots of different rating systems, Sustainalytics, Refinitiv, MSCI, and others, all with varying methodologies on relative versus absolute measures or time frame interpretations. So there's a huge problem with things like greenwashing and selective disclosure. And we've been seeing quite a bit of publicity recently with investigations at Deutsche Bank and Goldman Sachs into their fund managers. But it's not just the fund managers; it's actually the companies they're investing in as well. Upstanding companies like Boeing versus Airbus, or Microsoft versus Apple, or oil companies like Exxon versus Chevron. There's just not really any way to reconcile and compare company to company, or for that matter, mutual fund to mutual fund. Further, the ESG ratings may embed a perceived bias, perhaps against oil companies and in favor of consumer technology names. Some investors want this, but some do not. More refined rating systems that may recognize, say, a good oil company from a bad oil company, well, those could well be ostracized. It's been said that ESG investments may well outperform other investments simply because people want to do good by buying ESG. But the disarray in ESG today is driving outflows and repelling well meaning investors. Perhaps ongoing investigations will result in more cohesive ESG ratings approach driven by much needed regulation, but such a solution will not be fast and easy. It will take time. Coming in at number 2 on our top 5 list is the question: are consumers diverging into haves and have nots? In recent weeks, there's been a widely divergent stock performance between the retailers that cater to price sensitive, low end shoppers and those that cater to higher end, fashion sensitive shoppers. The chart here tells the story, with Walmart and Target getting crushed, but Nordstrom and Tapestry holding up rather well. Again, does this mean the low-end consumers are being hit harder in the current economic environment than high-end consumers? Short answer is no. It's not really about the division in consumer behavior, but rather about how the companies that cater to those consumers operate in this economic environment. Here's what's really happening. Walmart's customer base of value shoppers is highly price sensitive, so Walmart has been eating higher costs to protect their customer base. Now, with customer base changing in a return to normal post COVID environment, Walmart is writing off scads of high cost inventory. All the mass merchants are seeing stocks under pressure as inventory is written off. In contrast, Nordstrom has less price sensitive consumers and can selectively pass along higher inventory costs. So Nordstrom really has no need to take the inventory write downs. Most of the high end retailers are holding up comparatively well against the mass merchants like Walmart, Target, BJ's, and others. Coming in at number 1 on our top 5 list, we'll revisit the inflation theme. It's worth looking into more detail of the risk of inflation expectations getting built into the expectations of society at large. One way to get a sense for built-in inflation is to really just look at wage inflation, since wage inflation really is the origin of built-in inflation. Why is that? Well, wages, unlike prices, they just never go down. A weak labor market results in layoffs and unemployment, but never really lower wages. And once wages lift, then higher wages can lead to higher prices in what's known as the dreaded wage price spiral. The chart here shows wage inflation is actually at a 40-year high right now. Last time wage inflation reached this level, the Fed raised rates to 20%. Ouch. Of course, that was after 8 years of post-OPEC inflation fighting, a scenario that does not really exist today, so we probably won't have Powell raising rates to 20%. Still, built-in inflation is at an elevated risk today. Are we headed into built-in inflation? Well, we are cautiously optimistic that we're not headed that direction. Now, granted, wage inflation is high, and the Ukraine and perhaps China may still present supply chain risks. But recent wage inflation is less than 2 years old, very different from the 1970s, where we had 8 straight years of inflation leading into the built-in inflation. Further, we should see some easing of supply chain bottlenecks. And of course, the Fed action is already beginning to weigh on select non-energy prices. Automobiles come to mind. Also, wage comparisons do get easier as we near the end of the year. In summary, we still need to be vigilant, but built-in inflation does seem unlikely. We now want to move on to our final chapter of our slideshow, Chapter 3, where we provide a little bit more historical context on the stock market, especially during bear markets. While we've discussed quite a bit about prior recessions and prior rate hiking cycles, this chart is more evidence that every bear market really is unique. The chart shows sector performance of the S&P 500 over the last 4 bear markets. The present sell-off shows all sectors down with the exception of energy, as we discussed earlier. But in the prior bear market 2 years earlier, energy was actually the worst performer. Going back to the dot-com bust recession of 2000 to 2002, the consumer staple sector was the top performer, a sector that's not doing so well today after the blowups at Walmart and Target. And in the Great Recession of 2008-2009, the financials were the dogs of the Dow, but that was a sector that held up quite well in the dot-com bust. While this table only goes back a little over 20 years, it's fair to say that undercurrents beneath every bear market are unique and reflective of the times. This chart gives a much deeper historical context to the stock market, going back nearly 200 years, or 194 years to be exact. As you can see, the average stock market return of about 10% over the years varies quite a bit in any given year. The variance does follow a normal distribution pattern. In a challenging market like we have so far in 2022, it's worth revisiting some of these historic ranges. Of course, past returns are no guarantee of future performance, as the saying goes. Still, we've had really only 1 year down more than 40% for the year. That was 1931, early start of the Great Depression. We've had 5 years at the opposite end, plus 50% to plus 60%. The most common bucket is the 0 to 10% category, where 46 of the last 194 years have landed. And about 2/3 of the time, the return is between minus 10% and plus 20%. Hopefully that gives some context for where we're at right now with the market down 20%. That is an unusual occurrence relative to historic distribution of returns. In fact, only 14% of the last 194 years have had returns that were actually below minus 10%. Our final slide today is a simple reminder that bear markets frequently lead to bull markets. This table looks at the 14 largest drawdowns on the stock market since the Great Depression, and then shows the returns in the subsequent 1, 3, and 5-year periods. This is not a suggestion to buy at the trough. Market timing is a bit of a fool's errand in our view, but rather it's a reminder that you need to be present when the market does turn. A few other observations here. Average duration for these large drawdowns is a little over a year, 1.22 years, or about 5 quarters. Average period across all drawdowns, including the smaller drawdowns, is likely shorter. In the prior slides, we highlighted that today's drawdown and rate hiking cycle has the most parallels with the 1980-81 cycle, a cycle that resulted in the 1980-82 drawdown of 27.1%. And that cycle then saw a 5-year post-trough return of an incredible 224.5%. Now, unlikely that our future post-trough return will match that precisely, but at a minimum, we can say that bear markets do frequently lead to bull markets. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.